Good day and good evening, wherever you are in the world and watching this webcast. I am Diniko Denere, IASB Technical Staff, and I would like to welcome you to the Exposure Draft 3rd edition of the IFRS for SMEs Accounting Standard webcast. This presentation provides a brief background on the IFRS for SMEs Accounting Standard and summarizes the main proposals in the Exposure Draft 3rd edition of the IFRS for SMEs Accounting Standard that was published in September 2022. The Exposure Draft is open for comment until 7 March 2023. Let's start by having a look at the background of the IFRS for SMEs Accounting Standard. The IFRS for SMEs Accounting Standard is intended to apply to general purpose financial statements and is intended for use by entities that do not have public accountability. Entities that have public accountability generally include entities whose debt or equity instruments are traded in a public market and which hold assets in a fiduciary capacity for a broad group of outsiders. That is, they are entrusted with assets of other persons. The IFRS for SMEs Accounting Standard is not intended for these types of entities. The IFRS for SMEs Accounting Standard is based on full IFRS accounting standards and is modified to reflect the needs of the users of the SMEs financial statements. The IASB maintains the standard by periodic review, as when it was developing the standard, it was told that these reviews would reflect better the resources available to SMEs. The periodic reviews are expected to be not more frequently than once every 3 years and will consider new and amended IFRS accounting standards and other issues that have been brought to the IASB's attention. The IASB commenced its second review of the IFRS for SMEs Accounting Standard in 2019, having completed the first review and made limited changes to the standard in 2015. In January 2020, the IASB published a request for information, which asked for feedback on a framework for deciding whether, how, and when to amend the IFRS for SMEs Accounting Standard for new and amended IFRS accounting standards. In September 2022, based on the feedback from the request for information, the IASB published an exposure draft of proposed amendments to the standard. In 2019, when the IASB began its second comprehensive review, it had two questions. What should be the scope of the review, and what approach should it take for the review? In the first comprehensive review, the IASB deferred the decision to update the IFRS for SMEs Accounting Standard for some IFRS accounting standards that at the time had only been recently issued, including IFRS 10 and IFRS 11. It therefore, in starting this review, needed to decide whether it should include those standards in the scope of the second review. The IASB decided that it should include these standards. This resulted in the second comprehensive review having a broad scope, which includes 8 standards, the revised conceptual framework for financial reporting, and a number of amendments to full IFRS accounting standards, as well as IFRIC interpretations. In setting the scope of the review, the IASB members had differing views on whether the standard should continue to be based on full IFRS accounting standards. Consequently, there was a need to manage these diverse views. So, the IASB developed the alignment approach. The alignment approach asks the IASB to consider 3 principles in deciding whether the IFRS for SMEs should be amended. The principles are: relevance to SMEs. Would the change affect the decisions of users of the financial statements of SMEs? If and only if the IASB identifies that the amendments to IFRS accounting standards would make a difference, it considers making a change. Simplification. If the topic is assessed as relevant for SMEs, the ISB thinks about the resources available to SMEs and considers simplification of the requirements. For example, the ISB is proposing to introduce an expected credit loss model. However, the model is simplified based on the simplified model in IFRS 9 and would apply only to financial assets that are not trade receivables or contract assets. Lastly, faithful representation. Having applied the first two principles, the ISB considers if the outcome would be a faithful representation of the transaction. Having provided background, the next section provides an overview of the outcome from the IASB's deliberations on the feedback from the request for information. The conceptual framework for financial reporting forms the basis of full IFRS accounting standards. As the IASB updates IFRS accounting standards, they become consistent with the new conceptual framework. To ensure consistency when applying the alignment approach, the IASB is proposing to replace the section of the IFRS for SMEs Accounting Standard that addresses concepts and pervasive principles and which is based on the old 1989 IFRS framework with a new section based on the 2018 revised conceptual framework. Although the IASB did not amend for IFRS 3 in the first comprehensive review, it is now proposing to update the definition of a business, which was clarified in response to the post-implementation review of IFRS 3. The IASB wanted SMEs to benefit from the same clarifications as available to those applying the full IFRS accounting standards. It is also proposing to introduce the acquisition method, including the definitions of assets and liabilities from the new principles and concepts section. The IASB is proposing to simplify this by not changing the recognition criteria for intangible assets acquired in a business combination, not providing specific guidance on reacquired rights, and not introducing the option to measure non-controlling interests at fair value. The IASB is also proposing that contingent consideration be measured at fair value, unless doing so would require undue cost or effort, in which case an estimate of the most likely amount is permitted. The IASB looked at topics in IFRS 9 individually, applying the alignment principles. Looking at each topic, the IASB is proposing to remove the option to apply the recognition and measurement requirements in IAS 39. For classification, no change is proposed, except if the examples in the current standard do not fit to the financial instrument held, in which case the IASB is proposing a principle to determine classification. The principle is based on the contractual cash flow characteristics of the financial instrument. For subsequent measurement of financial assets, as noted earlier, the IASB is proposing to introduce a simplified expected credit loss model for financial assets that are not trade receivables or contract assets. Therefore, if an SME has only trade receivables and/or contract assets, it will continue using the incurred loss model. The IASB considered that users' information would be enhanced by using an expected credit loss model, but recognized that for most SMEs with only trade receivables, the costs could outweigh the benefits. The IASB is proposing requirements for issued financial guarantee contracts, as advised by its specialist advisory group, the SME Implementation Group. The IASB is proposing for financial guarantee contracts to no longer be measured at fair value, but at the premiums received or receivable on initial recognition, and subsequently measured at the higher of the expected credit losses provision or the initial amount recognized, amortized on a straight line basis over the life of the guarantee. There are no changes being proposed to hedge accounting, as the current practice is working well. Overall, in applying the alignment approach, a balanced outcome was achieved for IFRS 9. In the request for information, the IASB asked for views on aligning the definition and/or requirements for IFRS 10 and IFRS 11. There was strong support for aligning key definition, and that is what the IASB is proposing for IFRS 10 and IFRS 11. The IASB is proposing to update the definitions. However, importantly for IFRS 11, the IASB is not proposing to change the 3 categories of joint arrangements. IFRS 13 was considered during the first comprehensive review, but the IASB decided not to update at that time. IFRS 13 does not prescribe when to use fair value. This is prescribed by other IFRS accounting standards, but rather it provides guidance on how to measure fair value. The IFRS for SMEs standard already requires or permits fair value under some sections. The IASB is proposing to introduce the updated definition of fair value and new guidance that is more comprehensive than the current guidance. Finally, the IASB is proposing a new section that is based on IFRS 15. This proposal is based on feedback to the request for information. The new section introduces the 5-step model based on IFRS 15 and provides guidance on how to apply each step of the model, which results in a robust framework for revenue recognition. The IASB is proposing some simplifications to IFRS 15, including for contract modifications, separating warranties, and variable consideration. The IASB decided not to propose amendments for IFRS 14 in this review. This is because it has an ongoing project on rate-regulated activities and will await the outcome of the project. In the request for information, the IASB asked for views on alignment with IFRS 16. Based on the feedback, the IASB has decided to defer consideration until the next review of the IFRS for SMEs Accounting Standard. The deferral reflected, firstly, views of users of SMEs financial statements who are more focused on cash flows, and secondly, the potential implementation costs. In the next review, the IASB will have the benefit of the post-implementation review of IFRS 16. This presentation provided a brief overview of the exposure draft. I encourage you to visit the IFRS Foundation's webpage where there is more detailed information available to support the exposure draft. This includes an update newsletter on how the IASB has responded to user feedback and a snapshot document that summarizes the proposals and expected implications for SMEs and users of the SME financial statements. Thank you for listening to this webcast and for your interest in this project.